Using the wrong stock market order type can cause you to make mistakes and ultimately lose money. That's why by the end of this video, you'll know exactly how and when to use each of the 5 main order types needed to trade with complete confidence. Using relatable examples, we'll also walk through buying and selling step by step on a real investing app. Okay, so the order type you choose simply tells your trading platform how you want your trade to go through, whether it happens instantly, at a certain price, or only if the stock moves a certain way. Understanding a market order sets the foundation for using the other 4, so let's begin there. Think of a market order like going to a coffee shop, looking at the menu, then ordering a coffee at the listed price. You're not a weirdo, so you don't negotiate with the barista. A market order works the same way. You're saying that you're happy to buy or sell stock at whatever the current price is, no questions asked. Out of the 5 order types, a market order is the fastest way to buy and sell because your order goes through almost instantly, but that can also be a downside, and you'll see why in a second. We're using Webull for today's example because they have a built-in feature that lets you practice buying and selling stock 100% risk-free. This lets you apply what you're going to learn in this video and make every mistake in the book so you can jump into real investing and trading with confidence. Now, you'll also get a cash bonus or free stock for signing up and depositing, steps needed to get started anyway, so don't miss out on free value if you're interested in Webull. The link in the comment section below shows you what you'll currently get and a way to sign up. While we are using Webull for this example, what we're going through applies to any broker, whether you're using Fidelity, Schwab, Moomoo, Robinhood, or any other. So what you're gonna do is click trade on the bottom left of the screen once you found a stock you're interested in buying. If you don't know what to buy yet, that's okay. You don't need to worry about it right now. Now, this is the order form. This probably looks overwhelming, but that's completely okay. I'm going to show you exactly what to focus on. Start by clicking buy or sell, then you'll see order type. Click that drop down and we'll start with a market order. You'll then enter the number of shares to buy or sell. We'll enter 1 here. Then you'll see trading hours and time in force. These aren't important for market orders, but they're really important for the other 4 order types, and you'll see why in a second. Your broker will then display the estimated order total, which for 1 share of Amazon using a market order is about $216.44. Now, the market closed about an hour and a half ago, but for this video, as we go through each order type, we're going to assume that the market is open. Now, when using market orders, the price you buy or sell at can be different than what's shown here. This is because the current price is always changing. You need to be careful here though, and I'll show you why in a second. To submit the order, hit buy. Double check the order details and hit confirm. If the market is open, your order will go through almost instantly. But there's one major problem with market orders. You can end up paying a lot more or receiving a lot less for your shares than expected. If the stock is rapidly rising between the time you submit your order and it going through, the stock can be trading much higher. Now, if the stock is in free fall when you're trying to sell your shares, you can actually get far less than you expected. Even though market orders go through almost instantly, there's still a tiny window between you placing the order and it actually going through. This isn't always a big deal, but to prevent this, you need to know how to use a limit order. A limit order gives you complete control over the price you pay or receive when trading and protects you from your order going through at unexpected prices. Think of it like buying and selling an item on Facebook Marketplace. Instead of buying at the listed price or selling at the first offer you get, you negotiate until you agree on a price you're satisfied with. A limit order works the same. You decide the price to buy or sell at, and the order won't go through until the stock reaches your price or better. This does 2 main things. 1, it protects you by guaranteeing you get a specific price or better, and 2, it means your order won't go through instantly by default. On your broker, start by choosing limit from the order type dropdown. You'll then see a box labeled limit price. This is where you enter the price that you want to buy or sell at. So let's visualize this. Say Tonka Jahari wants to buy Amazon stock, but he's not satisfied with the current price of about $216. Instead, Tonka would happily buy Amazon at $200. So he'd enter $200 in the limit price box. Then in the next box, he'd enter the number of shares. Now, once Tonka submits this order, the trade won't happen unless Amazon falls to $200 or lower. But before submitting, you have a drop down for trading hours and time in force. These tell your broker when you want your order to go through and for how long. For trading hours, you have 3 options, each impacting your trade in a different way. You have only regular hours, extended hours, and overnight trading on Webull. Regular hours only mean your order can only go through during the main market session, which runs from 9:30 a.m. through 4 p.m. Eastern Time. By including extended hours, your order can go through beginning at 4 a.m. all the way through 8 p.m. For overnight trading only, your order can go through outside of regular and extended hours trading. But which one should you use? To give your order the best chance of going through, choose extended hours trading or overnight trading, depending on the time you're placing your order. For time in force, you can choose day or good till canceled. Since limit orders don't go through right away by default, time in force tells your broker how much time to give your order to go through. By choosing day, the order will automatically cancel at the end of the same trading day if the stock doesn't reach your limit price. Good till canceled gives your order the chance to go through for 60 days before automatically canceling if the stock doesn't hit your price. You'll then hit buy, double check the order details, and hit confirm. You might see a pop-up warning you that the limit price you set isn't close to the current price. That's normal, just hit continue. Now, a limit order helps you get the price you want when buying and a good price when selling, but it doesn't always work out the way you want. What happens if the stock suddenly drops before you notice and you don't have time to react? That's why you need to have a stop order in your toolbox. It's like a built-in safety net once you already own the stock. A stop order automatically sells your stock if the price drops too far, protecting you from a small loss turning into a big one. Think of it like a smoke detector in your house. You set it up, hoping you never need to use it, but if things do get bad, it automatically triggers to protect you. A stop order works the same way. Once the stock falls to your set price, it instantly sends a market order to sell your shares at the current price so you can get out as fast as possible. Let's say Tonka Johari did buy Amazon at $200 per share. He could then set a stop order at $190. If the price falls to $190, Tonka's broker would instantly send out a market order to sell his shares. This saves him from having to stare at the screen all day because the stop order automatically protects him if the stock moves against him. On your broker, select stop order from the drop down. On your broker, start by clicking sell, then choose a stop order from the drop down. Then you'll see a box labeled stop price. This is a price where your broker will automatically trigger a market order to sell your shares. Using Tonka's example, we'll enter a stop price of $190. Then enter the number of shares, and under time in force, choose day or good till canceled. Tonka wants the protection of a stop order to stay in place for as long as possible, so he'll select good till canceled. But just like a regular market order, there's one main problem. If the stock is in free fall, you might get less for your shares than you expected. A stop order isn't guaranteed to sell at your stop price. That's just the point where a market order is triggered. By the time it actually goes through, the stock could already be trading lower. And that's why you need to know how to use the next order type, a stop limit order. It's like a regular stop order, what we just went through, except once your stop price is hit, it places a limit order instead of a market. This means you'll only sell if you can get the minimum price you want or better. Back to Tonka, he could set a stop at 190 and a limit at 185. If Amazon fell to 190, a limit order would automatically trigger and only sell his shares if he can get 185 or higher. Now, the closer to 190, the better, but this prevents Tonka from selling his shares at an even lower price than 185, something that's possible with a regular stop order. On your broker, start by making sure sell is selected, then from the order type dropdown, hit stop limit order. This time you'll see a box labeled stop price and limit price. Using Tonka's example, we'll leave 190 for the stop price, then for the limit price, we'll enter 185. You should always set the limit price lower than the stop, otherwise the order may not go through. Since a limit order is placed only when the stop price is hit, Amazon could already be trading lower by the time the limit order has the opportunity to go through. At that point, you could end up holding on to the shares and riding the stock lower. Next, enter the number of shares you want to sell, then choose day or good till canceled for time in force. Hit sell at the bottom, hit continue, double check the order details, and hit confirm to set your stop limit order. Okay, so stop and stop limit orders are great at protecting you from losses, but they don't help you lock in profits. If you're not glued to the chart all day, the stock can drop and wipe out gains you already made. But that's what a trailing stop order does for you. A trailing stop automatically adjusts your stop price as the stock goes up. If the stock reverses and drops by a certain dollar amount or percentage, your broker automatically sells your shares. Think of it like a bodyguard following a few steps behind everywhere you go. Everything's fine until they sense danger. Then they step in to protect you. A trailing stop works the same way. The stop moves up with the price, but if the price falls, the stop stays in place and triggers a sell order. For example, let's say Tonka Jahari buys Amazon at $200 and sets a trailing stop at $5. If the stock were to rise to $210, his stop automatically moves up to $205. But if the price falls $5 from that new high, his broker instantly places a market order to sell, locking in profit before the drop gets worse. The key is that the stop only moves up with the stock, never back down. On your broker, start by making sure sell is selected and you already own the stock. Then choose trailing stop order from the order type dropdown. This time you'll see a box labeled trail amount. This is how much room you give the stock to move before your stop order sells. By entering $5, this sets your stop $5 below the stock's next high price after you place the order. A larger trail gives the stock more room to move before selling, while a smaller trail locks in profit faster, but it might trigger early on normal price swings. For steadier stocks like Amazon, a smaller trail can work fine. But for crazier ones like Tesla, where there's huge swings in price, a larger trail is usually safer. Next, enter the number of shares to sell. Then, for time in force, day is the only option when using a trailing stop order on Webull. Your broker may offer additional options though. Okay, so when should you actually use each of these 5 order types to avoid messing up your trades? You'll want to write this down. Use a market order when you want in or out of a stock immediately and the price isn't moving too fast. These are perfect for long-term investors who just want their trade to go through right away. Use a limit order when you want control over the exact price you buy or sell at, down to the penny. Limits are best for day or swing traders and especially helpful when a stock is moving quickly. Stop orders are best when you already own a stock and want to protect yourself from big losses. It's the fastest way to automatically sell if the price drops, unlike stop limit orders, which might not go through if the stock falls too fast. And you'll want to use a stop limit if you want that same automatic protection, but also want to make sure you don't sell below a certain minimum price. Then use a trailing stop when your goal is to automatically lock in profits as the stock rises without needing to constantly watch the market. Now, if you're planning to get started with Webull, you'll want to watch this Webull tutorial for complete beginners video to confidently take advantage of the features that'll benefit your trading.